Hello, investors. My name is Joe Torre. I'm an investment counselor here at Real Wealth. And today we're going to do a short video on how real estate investing reduces your retirement risk. Now, at Real Wealth, we don't really think in terms of retirement. We think in terms of living life on your own terms and being job optional. But the reality is most of our investors are looking for real estate as part of their retirement plan. So today we're going to talk about 3 risks to your retirement and how real estate can help you mitigate those risks. So here are the 3 risks. There's longevity risk, which we'll discuss, investment risk, and inflation risk. So the first one, longevity risk, what is that? That's when you run out of savings before you run out of life. So you're elderly, you exhausted all your life savings, and you're still healthy and going, and you have no money left. That's the number one fear of people when they're doing retirement planning, is that they're going to outlive their savings. So that's longevity risk. Now, real estate helps with that because well-maintained real estate produces income indefinitely. If you own 5 houses or 10 houses or an apartment building, that property will continue to spew cash month after month, year after year, as long as you're around. And then you can eventually pass it on to your heirs down the road. So you don't have to worry about burning through your stock market portfolio or anything like that. You have an asset that's generating cash, and that can help you last longer in your investing. The second risk is investment risk. And what that is when you have your money in the stock market and the stock market crashes and your nest egg goes down in value. Your 401k turns into a 201k. And this is especially harmful if it happens right after retirement. So here's an example of the S&P 500. You can see the map from 1980 to 2020, 40-year period. There are a couple of periods here, like in the dot-com crash in the 2000s and then 2008 when the financial crisis happened. So you can see the S&P 500, which is a proxy for the stock market, it was cut in half. It went from 1,500 down to about 750. So imagine if you had bad timing and you had retired in 2008 and you had to burn through your stock market holdings faster than you planned to. Maybe you plan to sell 100 shares a month to meet your living expenses, but because the stock prices are half of what they used to be, now you have to sell 200 shares a month to meet your living expenses. And you burn through your nest egg very quickly. So you can see it took, 2014, it took 6 years for it to recover back to the 2008 levels. By that time, you might have burned through all of your retirement nest egg. Now, you can see that this S&P recovered after that, and that's great, but it's small consolation to you if you have no stock left because you burned through it during the bad times. So that's what investment risk is, where you put your money in the stock market, and depending on what happens, it doesn't last. So how real estate can help? Well, number one, it gives you diversification from the stock market. It's good to have some of your assets, a significant amount of your assets in assets that are not correlated to the stock market. And also, real estate produces income consistently. So if you have a property and you're getting $1,000 a month in rent, that $1,000 a month is pretty stable. The home prices can change if interest rates go up or other things happen. Maybe the market gets soft and your property value goes down, but the rents generally don't go down. Maybe you won't be able to increase rents when times are bad and there's a recession or something like that. But maybe at worst, your $1,000 rent will go down to $950 or $900. But for the most part, rental income is very stable, certainly more stable than the stock market and more stable than real estate home values. So that's a good way to shelter yourself from investment risk. Finally, we'll talk about inflation risk. This is when the cost of living rises faster than your income. This is especially dangerous to retirees on fixed income like Social Security. So Social Security is adjusted for cost of living adjustments. They call them COLAs. Two things about that. Number one, the government has a $33 trillion national debt. So they're very reluctant to increase these cost of living adjustments. They'll drag their feet and give you the minimal amount that they can get away with. And also, the cost of living adjustments are based on the Consumer Price Index, the CPI. But medical expenses tend to grow much faster than the consumer price index. The consumer price index is based on a basket of goods like food, gasoline, and so forth. Medical expenses grow much faster than that. So later in life, you're going to have a much more of your income is going to be spent on medical expenses than other things. So cost of living adjustments don't really protect you much from inflation risk. Real estate does, though, because real estate does really well during times of inflation. So when inflation is going strong, rents go up, property values go up, and your mortgage can be paid off with depreciated, devalued dollars. You can look at the 1970s. That was a period of rampant inflation, and you could see that real estate did very well during that time period. So to summarize, the retirement risks: longevity risk, outliving your savings. Real estate can help you because it produces income indefinitely. Investment risk, especially with the stock market. Real estate can help you because rental income is more stable than home prices or stocks. And inflation risk, real estate can help you because real estate does really well during periods of inflation. So what's your plan? If you're not currently investing in real estate, what is your strategy for dealing with longevity risk, investment risk, and inflation risk? If you don't have a plan, then maybe you should take a look at real estate investing and put at least part of your portfolio in real estate investments. To learn how to do that, just go to realwealth.com and you can get a free membership. You click on this button here from our homepage, join for free. There's a new investor core curriculum series. It's 4 short videos, about 15 minutes each, and it gives you a crash course on what you need to know to get started investing in real estate. And if you want to learn more than that, we have a library of over 900 webinars on all real estate topics. Additionally, we have weekly educational webinars every Thursday, and those webinars are added to our website by end of day Friday, and podcasts as well. And when you're ready, you can speak to an experienced investment counselor like myself. You can get all your questions answered and get some advice about how to move forward. So I hope that gives you some insights about how real estate should be a part of your portfolio to help you manage retirement risk. Thanks for watching.